Ever wondered how your credit score is calculated? It's a magical number that can open doors to financial freedom or keep them closed. Your credit score is like a report card of your financial health, and it matters a lot. It can impact everything from the interest rates you pay on loans to your ability to rent an apartment or even land a job. But what goes into this critical number? Here's the scoop. Your credit score is a complex algorithm, a mathematical equation that crunches data from your credit report. While the exact formula is a closely guarded secret, we do know the key components that make up the score. First up, we have payment history, which accounts for about 35% of your score. This factor measures your track record of making on-time payments. Think of it as your reliability quotient. Next, we have credit utilization, which makes up about 30% of your score. This factor looks at the percentage of your available credit that you're currently using. In simple terms, it's about how much of your credit card limit you're using. Then, there's the length of credit history, which contributes to about 15% of your score. This factor takes into account the age of your credit accounts, including the average age of all your accounts. The fourth factor is credit mix, accounting for about 10% of your score. This measures the variety of credit accounts you have. It's like a financial diversity score. Lastly, we have new credit inquiries, also contributing to about 10% of your score. This factor notes the number of inquiries made by lenders when you apply for new credit. So there you have it, the 5 pillars that hold up your credit score: payment history, credit utilization, length of credit history, credit mix, and new credit inquiries. But understanding these factors is just the beginning. The real magic happens when you know how to improve each one. So, stick around as we delve into each of these factors in detail. Together, we will unlock the secrets to a better credit score. Scene script. First up, we have payment history, which makes up a whopping 35% of your credit score. Now you might be wondering, what exactly is payment history? Well, it's a record of your consistency in repaying your debts. It measures whether you've been diligent in making payments to creditors on time. When it comes to your credit score, your ability to consistently pay your bills promptly is of paramount importance. Think of it this way. If you were lending money to a friend, wouldn't you feel more at ease if you knew they had a history of always paying back on time? It's the same principle with lenders and your credit score. So how does one go about improving their payment history? Well, it's simple really, just pay your bills on time. It might sound like a no-brainer, but it's surprising how often this is overlooked. Late payments, even by a day, can have a significant impact on your credit score. One way to ensure you never miss a payment is by setting up reminders or automatic payments. Most banks and credit card companies offer these services, and they can be a real lifesaver. With automatic payments, you can set it and forget it, knowing that your bills will always be paid on time. But what if you're already behind on payments? Well, it's never too late to start improving. Begin by making a plan to catch up on your overdue bills and commit to making all future payments on time. Remember, your payment history is a reflection of your financial responsibility over time. So, while late payments will impact your score, their effect will lessen as you establish a consistent record of on-time payments. It's also worth noting that not all late payments are reported to the credit bureaus. Generally, payments less than 30 days late are not reported, so if you've missed a payment, it's best to pay it as soon as possible. Finally, keep in mind that while payment history is a significant component of your credit score, it's not the only factor. Stay tuned as we explore other critical aspects of your credit score in the next segments. Always remember, pay your bills on time. Next on the list is credit utilization, accounting for 30% of your score. Now you might be wondering, what exactly is credit utilization? Well, it's the percentage of your available credit that you're currently using. In other words, it's a measure of how much of your total credit limit you're spending. It's also known as the credit utilization ratio. So, why is this so important? Credit utilization is a key factor in your credit score because it gives lenders a snapshot of how reliant you are on credit. If you're using a high percentage of your available credit, lenders may view this as a sign of potential financial stress, which could make them less inclined to extend additional credit to you. A lower credit utilization ratio, on the other hand, suggests that you're managing your credit responsibly and not maxing out your credit cards. This is a positive sign to lenders and can contribute to a higher credit score. Now, how can you manage your credit utilization effectively? Firstly, aim to keep your credit card balances low in relation to your credit limits. For example, if your credit limit is $5,000, try to keep your balance below $1,500. That's 30% of your limit. which is the recommended maximum level of credit utilization. Another approach is to pay your bills more than once a month. By making multiple payments in a billing cycle, you can reduce your balance and thus your credit utilization ratio. Furthermore, if you're in a position to do so, consider asking your credit card issuer to increase your credit limit. But remember, this doesn't mean you should increase your spending. The goal here is to lower your credit utilization ratio, not to rack up more debt. Lastly, be aware that closing old credit cards can increase your credit utilization ratio because it reduces your total available credit. So think twice before you close that old credit card. In conclusion, managing your credit utilization effectively is a key aspect of maintaining a healthy credit score. Aim to use less than 30% of your available credit. Scene script, length of credit history, making up 15% of your score, is our next point of discussion. Diving right in, the length of credit history, also known as credit age, is all about the duration of your credit accounts, both new and old. This factor considers the age of your oldest account, the age of your newest account, and an average age of all your accounts. It's like a time capsule of your financial journey, providing lenders with a snapshot of your credit experience over time. Now, why does the length of credit history matter? Well, it offers lenders a more extended look at how you've managed credit. Longer credit history typically provides more information, and therefore might result in a higher credit score, assuming that history demonstrates responsible credit usage. So, how can you improve this aspect of your credit score? Here's a tip. Don't be too quick to close those old unused accounts. Even if you've moved on to shinier cards with better rewards, keeping your older accounts open can benefit your credit score by lengthening your overall credit history. It's like keeping a piece of your financial past alive, and it can help paint a more favorable picture of your creditworthiness to potential lenders. On the other hand, opening a flurry of new accounts within a short period can lower your average account age, potentially causing a dip in your credit score. So, while it might be tempting to jump on every appealing credit card offer that comes your way, it's a good idea to apply for new credit sparingly. Remember, patience is a virtue, especially when it comes to building a robust credit history. It's a marathon, not a sprint. Consistently demonstrating responsible credit behavior over a longer period will likely be more beneficial to your credit score than a short burst of activity. So, in summary, to give your credit score a boost, think long-term. Keep your older accounts open, apply for new credit only when necessary, and above all, be patient. Your credit age will grow naturally over time, and so too will your credit score. Keep those old accounts open, they're helping your credit score. Our fourth factor is credit mix, which contributes to 10% of your score. Now, you might be wondering, what exactly is credit mix? Well, it's the variety of credit accounts you have. This may include credit cards, installment loans, mortgages, and even retail accounts. Credit mix is a bit like a financial cocktail. Just as a good cocktail has a mix of ingredients, a good credit profile has a mix of credit types. Why does this matter, you ask? It's because lenders want to see that you can handle different types of credit responsibly. Having a diverse credit mix shows lenders that you're capable of managing various types of debt, which can make you a more attractive borrower. So how can you improve your credit mix? The key is to diversify your credit over time. This could mean having a blend of revolving credit, like credit cards, and installment credit, like a mortgage or auto loan. But remember, it's not about opening as many accounts as possible. Quality over quantity is the name of the game here. For instance, if you only have credit cards, consider adding an installment loan to the mix, like a car loan or a student loan. Or if you only have installment loans, you might want to consider getting a credit card. But remember, only open new accounts when necessary. It's not a good idea to open a bunch of new accounts all at once, as this can appear risky to lenders. The most important thing to remember about credit mix is that it should come naturally over time. It's not something you should force. As you go through different stages of your life, your credit mix will naturally diversify. Buying a car, purchasing a house, or starting a business are all events that will contribute to a diverse credit mix. Diversify your credit, but remember, don't take on debt you don't need. It's all about responsible borrowing. Having a diverse credit mix can benefit your credit score, but only if you're managing it wisely. So, aim for diversity, but don't forget to keep your financial health in check. Last but not least, new credit inquiries, also making up 10% of your score. So, what exactly are these new credit inquiries? Well, when you apply for a new line of credit, be it a credit card, a mortgage, or a car loan, the potential lender will do a hard credit check to determine your credit worthiness. This is what we call a new credit inquiry. Now, you might be thinking, so what? They're just checking my credit, right? Yes, but there's a bit more to it. Every time a hard inquiry is made, it can slightly lower your credit score. This is because potential lenders may see multiple hard inquiries as a sign of financial distress, meaning you might be a riskier borrower. However, it's important to note that not all inquiries are created equal. For instance, rate shopping for a mortgage or an auto loan within a short period is generally treated as a single inquiry. This is because the credit scoring models understand that you're likely comparing rates, not trying to take on multiple loans. So, how can you manage these new credit inquiries? The key here is to limit new credit applications. Only apply for new credit when it's absolutely necessary. And remember, when you do apply, do your homework first. Know your credit score, understand the lender's requirements, and ensure that you're a good candidate before applying. This can help you avoid unnecessary hard inquiries that could hurt your score. Also, be aware of what's known as soft inquiries. These occur when you check your own credit score, or when a company does a background check, like when you're renting an apartment. Soft inquiries do not affect your credit score. So, feel free to check your own credit report as often as you want, without worrying about your score taking a hit. In conclusion, while new credit inquiries are a smaller portion of your credit score, they still matter. Each hard inquiry can chip away at your score, so be strategic about when and where you apply for new credit. Apply for new credit sparingly to avoid unnecessary inquiries. So, what have we learned about credit scores today? Firstly, we uncovered that payment history is a significant piece of the pie, making up 35% of your credit score. It represents your track record of making payments on time. The key to enhancing this aspect is simple: pay your bills on time, every time. Late payments can take a toll on your score, so setting up reminders or automatic payments can be a lifesaver. Next, we delved into credit utilization, which accounts for 30% of your score. This is all about how much of your available credit you're using. To boost this, aim to keep your credit card balances low in relation to your credit limits. Make it your goal to use less than 30% of your available credit. We then moved on to the length of credit history, which makes up 15% of your score. This is where the age of your credit accounts comes into play. To give this a boost, keep your older accounts open, even if you don't use them often. And remember, opening too many new accounts at once can lower your average account age. Our journey then took us to credit mix, which is 10% of your score. This considers the variety of credit accounts you have, such as credit cards, installment loans, mortgages, and retail accounts. To improve this, diversify your credit mix over time, but only open new accounts when necessary. It's crucial not to take on debt you don't need. Lastly, we explored new credit inquiries, which also make up 10% of your score. This is all about the number of inquiries made by lenders when you apply for new credit. The key to improving this is to limit new credit applications, as each hard inquiry can slightly lower your score. However, rate shopping for a mortgage or auto loan within a short time frame is usually treated as a single inquiry. In addition to these key elements, we also highlighted some general tips to improve your credit score. Paying your bills on time, reducing credit card balances, avoiding closing old accounts, limiting new credit applications, monitoring your credit, building positive credit habits, and above all, being patient. Remember, improving your credit score is a journey that requires consistent, responsible financial behavior over time. We also emphasized the importance of regularly checking your credit reports for errors and fraudulent activity. You can obtain free annual reports from the 3 major bureaus. And for those with limited or no credit history, consider starting with a secured credit card or credit builder loan to establish a positive payment history. So there you have it, a comprehensive guide to understanding and improving your credit score. But let's not forget the most important part of this journey: patience. Remember, improving your credit score is a marathon, not a sprint. Keep practicing responsible credit management, and your score will gradually increase.